welcome to my channel today. This is a King's Tutor. It's the first time of joining us, and sure you like, comment, share, subscribe to this channel. Now today we want to continue my the series from introduction, what is accounting and all that. And today we want to see the principles and practice of double entry. Double entry, very important. Now, double entry is basically the foundation of accounting. Okay, now it is called double entry or a dual aspect of a transaction. Now, double entry is a principle in accounting. Now, what does it state? So the double entry principle states that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. What it means is that in every transaction, a single transaction, two accounts is affected. One account is debited and another is credited. You debit the account that is receiving and you credit the account that is giving out. For instance, you might be wondering, what do you mean by debit and what do you also mean by what credit? Now, what this dual or double means, from the word double, it means two. It means for one transaction, you have two accounts that's affected. Definitely, one account or one person is giving while another person is receiving at the other end. So that person that is giving, that is a giver, his account is credited. Write it like this: credited or credit. In short form, it is written as CR. Okay? Why the other person that receives from the person giving is the receiver or is receiving, and that person is the receiver, and the account is to be debited. We call it debited. It is written short form as DR, not doctor. This is DR as what debited. Okay, so it means that for one transaction, for instance, when you say sold goods for cash, in this transaction now, there's a sold goods for cash 2,000. In this transaction now, two accounts is affected. One is debited and another is what? Credited. Okay, so if you say sold goods for cash, the first thing you have to do is to identify there are two accounts. That's the first procedure. So let's get it right. Double entry refers to what? A principle in accounting in which two full aspects of a transaction are recorded, or an account are recorded. Okay? Two full aspects in the sense that in a transaction, two accounts is affected. One account is receiving and another is what? Giving. So we debit the one receiving and we credit the one what? Giving. And in terms of debit, the debit is at the left hand side, while the credit is at the right hand side. For instance, now, if we want to record the transaction, the first thing we do is to draw both a vertical and horizontal line like this. Now, if you draw that, now the left hand side is what we call debit, while the right hand side is what we call credit. You see it? So everything that concerns from this half, you record the person receiving it or the account receiving it, while everything that concerns this in this half is the person giving it out. Okay, so that is what? Debit and what? Credit. Okay, so for instance, now the procedure for effecting double entry is whenever a transaction is given, the first thing you have to do, the first step is to identify the two accounts. Identify the two accounts there. For instance, now if I say sold goods for cash, now the two accounts that I can see here is cash and sales. It says sold goods for cash. It means a retailer sold goods, so he sold it for what? For cash, not on credit. So if it's for cash, every cash transaction goes to the cash book. We're going to see cash book in this channel. So every transaction goes to the cash book, and the next account is sales. So these are the two. So the first thing is to identify the two accounts. We said one transaction, two accounts affected. So if I identify the two accounts, probably I can call this cash and I can call this sales account. The same thing, it will have debit, it will have credit. And once you have identified the two accounts, now you write, draw the account into halves. And write down the debit and credit. Write down the debit and credit. For instance, after you've identified the account, you draw it vertical and horizontal and write down this debit and credit, Okay. Now, third one, identify the receiving account. Identify the receiving account and debit it. Okay. While the fourth one, identify the giving account and credit it. For instance, now the next thing now is to identify. They say sold goods for cash 2,000. Now in this now, since the sales they made is for what? For cash. They made sales for cash. So we have to record it here as sales 2,000. Then the sales account is giving out the goods. So right here, cash 2,000. Okay. So with that now we have effected this transaction. So you see that one transaction have two accounts is affected. One is debited, one is what? Credited. Okay, so that is the principle of double entry. Okay, that relates to debit and what? Credit. So basically, let's give an illustration on debit and credit, what it stands for. Debit and credit, what it stands for. The first one, for debit and credit. Now, every debit item means an increase in the value of assets. An increase in assets. Every debit item is an increase in assets. When you debit an item, it means the asset is what? Increasing. For instance, now look at cash. Cash is an asset. It's a current asset. Okay, assets are items that belongs to you. We have seen that in the introduction video. Please watch that. So items are what belongs to you. So since this item comes here, it means you are increasing the value or the amount there. That is what debit means. Okay, it means there's an increase in the value of assets. Okay, while credit means a decrease in value of that same asset. So for instance, if I record it here now, it means I'm reducing the value of this asset that is cash. Okay, so debit is the increase in the value of assets, while credit is what? Decrease in the value of assets. Okay, the next one is debit. Whenever an item is debit, it can be an item of expenditure or expenses. An item of expenditure or expenses. Whenever an account is debited, maybe that account is what? An item of expenses or expenditure. That's the rule. So while credit here can be an item of income. Can be an item of income. For instance, sales is an income. When somebody makes sales, it's an income. Okay, so it was credited. So an item of income can be a credit. Why? The third one for debit can be a decrease in liability. Liability means the money that is owed to outsider. So when there's decrease in that liability, it can relate to what? The debit, when an item is debited. While a credit relates to an increase in liability. An increase in liability. So these are the basic aspects of why we debit and credit. So it can stand for increase in assets, item of expenses, or a decrease in liability as debit, while credit can stand as decrease in value of assets, item of income, or increase in what? Liability. Okay, so that's the principle of double entry. In the next video, we're going to see the types of accounts to prepare, the subsidiary books, books of account, and the principal book of account. So from there, we'll take it on and show you like, comment, share, subscribe to this channel. Thank you very much.